How are you, folks? Enzo DiCostanzo, and today we'll be working on the third video in our stock valuation series, our second Excel, but our third video. So let's get right to it. Yes, simplifying the dividend discount model, non-constant growth, and valuing a business by discounted cash flow. Okay. All right, so we left off here the last video, which was a couple days ago. I was out of action a bit for a few days there this week. I apologize for. I wanted these a little more on top of each other, but okay, we did it sort of how we did it. And actually, there's three pieces. There's a Home Depot piece. There's a very generic model, like a theoretical textbook model, and then these other two pieces: the dividend discount and the non-constant growth. So the first case is the dividend discount model with no growth, which means the dividends are just the same, or dividends, a stream of cash flows, okay, are the same for a number of years, 5 years, 10 years. And again, we're dealing with this right now at work. All earnings paid out as dividends to common shareholders or the owners. Such companies cannot grow because it can never reinvest. And we assume it does not raise money by issuing new shares. So there's a lot of assumptions here. The dividend discount model says there's no growth. Shares itself for the present value of a constant perpetual stream of cash flows or dividends. The rate is the rate of return demanded by investors in other stocks with a similar risk. Okay, so again, this very innocent looking formula here, this is actually a big piece of your, let's say your first 20 years of your time horizon for valuation. That formula right there is a rather large piece of it because you have a cash flow divided by a rate of return, or your present value today times that rate of return. You could look at it like that. Earnings per share, dividend, those are all cash flows. Right, and this is a no growth perpetuity, and so G is 0 in this particular situation. We have the general formula here. So it says when G is 0, what this boils down to. So dividend today grows at a rate of G. You subtract the growth rate from the expected return. Okay, and then that would give you the value today. P of 0 is the value today. So your cash flow 1 year out, the growth rate. But if G is 0, the G's wash away, and this 1 plus 0 is just a 1, and it reduces to dividend divided by the rate of return, which is what we started with there. That's a little bit of a derivation. The Brealey-Myers, they have their valuations in there a bit. So okay, and actually, I always like to have it have the answer sort of nearby, if you don't mind. So you don't have to worry about if you can't see that. That's sort of almost on purpose. I mean, I can see it, but you have to worry about reading this. Yeah, don't worry about reading that. I'm just sliding that right over there, and we're going to work on this one. This one I want you to be able to see. And like I said, if you ever want to make any comments, so 160 I think is generally pretty good. If you ever want to make any comments about the font size or the magnification, always drop me a message regarding that. Okay, so we're looking here, Moonshine Industries. Funny enough, you guys know what moonshine is. Moonshine is sort of how the Southern stock car racing began. There was a time in this country where alcohol was against the law. It was called prohibition. It was a long time ago, and it spawned all sorts of organized crime. And in the Northeast, the Italians, certainly down south. So it's weird that they picked this terminology for basically organized underground selling of alcoholic products. And NASCAR, a couple things came out of it. NASCAR developed where the moonshine runners, who the folks in the hills in North Carolina and places like that who made the moonshine or made the alcoholic beverages, were transporting it, and their vehicles had to outrun the law enforcement vehicles. And that's how sort of stock car racing began. But it's weird that they picked this as an example, but okay. So anyhow, looking at this, we want to, and you want to, for a discount rate of 20% and a cash flow of very simple numbers. Now, obviously that's a rather large rate of return. What you're going to do is you're going to say, okay, well, the valuation today would be the earnings divided by the 0.2, which is your 125. Okay, yeah, we could have done that in either one of these places. So the value today or the price today, either one of those designations. But that's all that really is. So you divide by your expected rate of return on your cash flows going out. So that brings you, but this brings it back a year. Now, if you have a bunch of these going forward, we have to adjust for that because usually a perpetual cash flow doesn't start until maybe 5 or 6. Generally, in models, maybe 5 or 10 years out. So what you'll do is you'll value the cash flows. Let's say a year out from year 10. The end of maybe year 10. You want the beginning of year 10 or the end of year 9 or something, or maybe the end of year 11, and you want to bring it back to the end of year 10, something to that effect. So if you're at the end of year 11 with this 25 and you bring it back to 125, you got to discount the 125 back another 10 years to zero. But we'll deal with that case as we deal with all the pieces here. Okay. And now this was the no growth version is what this is. Dividend discount model, no growth. Case 2, dividend discount model, constant growth. Okay. And who was Gordon? I looked it up. I remember a number of years ago, I looked it up. He passed away this is about when I started at St. Peter's and was leaving Rutgers, I was at Rutgers too, but this was about when things, I met the Dolan folks, and I met a bunch of different people around this time, or maybe a year from this here now, but about that. But Miles Jules Gordon was a professor of finance at the Rotman School in Toronto. And with Shapiro, he published a method for valuing stocks or businesses known as the Gordon growth. I wish I'd put a little bit more, but I wanted to put a little more background, but I wanted the whole guy's name in there. So it's a version of the discount model where dividends grow at a constant rate. Okay, so G is not zero here. And we already observed this in the previous little block up there, our little previous Excel block. So the value today of a cash flow a year from now is divided by the discount rate minus the growth rate, and dividend 1 is equal to dividend today times 1 plus G, how that grows. And you can see the whole formula is written out here. Dividends paid at the start of the first year, dividends paid at the end of the first year, end of the second year, end of the third year, end of the fourth year. And what this looks like, 1 plus G times 1 plus, and this is really, again, we didn't go through the time value of money chapter in this particular section yet, or again, not really. I'm making this in December 2022, but we might have a course where we did go over time value of money, and this is just another component of it. But this is just growing a cash flow at a constant rate. So it's 1 plus that growth rate times the US dollar number. That's all that these are here, is just simply that. Okay, and this is just the time value of money. So now looking at this is the dividend sort of on the horizon kind of a situation, and these are the sort of the annual dividends, or if it's a 10-year model, this is dividend T equals 10 here or something to that effect. Like I said, there's component, and remember the components from last time. We had the present value of the cash flows and the present value of the terminal value type of a concept. We had both of those adding into the valuation, and over time the cash flows began to dominate over the terminal value percentage influence on the valuation today. So if G is 0, then we go back to this, the value of a no growth stock. But with the constant growth model, we generalize the perpetuity formula to allow for constant growth in dividends. And again, you're talking about operating in a vacuum. The accounting information is very important. You have sellers for specific assets. That's very important. And these models take into account, none of that. So, but those are really important pieces to the puzzle. Okay, this other piece here, this sort of restates this, but you're solving for R. Yeah, you're solving for R. Yeah, because this is dividend right here. You're solving for R here. So you let's see, this thing you can multiply both sides. P0. You have to do a little bit of algebra for this. What do we solve for? What do we do? Solve for R here. So what's the next step in this? So this would be PR minus G, right, equals dividend, and we'll put the subscripts in eventually. That. And then you're going to do PR minus GP equals dividend. And this is going to be dividend plus GP. And the whole thing is going to be equals PR. Whoops, PR. Yeah, dividend plus dividend by P divided by, yeah, plus G. Yeah, that's what it is. So then when you divide here, so you have dividend G equals R. Something like that. Okay. That's it. Yeah. And you could put all the subscripts. You could go back with this thing. And you start clicking all over the place. All right, and just throwing all your subscripts in here. Okay. I think that's, yeah, I think that's all. Oops. And we have a couple other P's here. So, see how we're doing this? So we're just going through and putting all these subscripts like that. And then you solve for R. Yeah. So you have this. So we have this. So we went through the math here, a little bit of algebra, right? And you guys can do the math on the side or whatever. And it says used to estimate the cost of equity. So yeah, and believe me, people in finance departments at NYU and places love cost of equity. Love to define that is, you know, all sorts of ways. In competitive markets, common stocks with the same risk or price to offer the same expected rate of return. Okay. And now we have another example here. This is Aqua America. And what is this? This takes the shares times what it's selling for. Yeah. So looking at this, I think this is a real company. It's a water utility serving parts of 14 states. At least it did at the time, a decade ago. Its stock was selling for $32 a share, and there was 141 million shares outstanding. Investors were placing a total value on 141 million shares at 4.5 billion. Can we explain the valuation? Well, I mean, this what happened here. So we can try to back that out as best we can. So I think what I did in sort of another life here, I went down here and said, okay, well, how many million shares? 141 million. We have that. Okay, so that's not 141. Look at the units. It's 141 million. So we came up here and said $32 times that 141 gave you about 4.5 billion. All right, that's what the market valuation on the equity of this company. And it's a confusing thing. I mean, you'll talk to people say, "Oh, well, yeah, well, the stock market just values the equity," and some people says, "Well, it's the enterprise value." And again, you get all these different, obviously the enterprise value combines the debt and equity valuation. Well, the debt market's a separate market, but it's the whole enterprise that you're looking at. Okay, so like I said, it could get and believe me, it's a lot more complicated and nuanced than you think, because what appears like the same terminology means a lot of different things to different people, and you're going to find that as you sort of roll through all of this. But this is it says the total value of the stock. Okay, that's the sort of the giveaway there. It could point to a remarkably consistent growth record. For each of the past 2 decades, it has steadily increased its dividend payment, and with one minor hiccup, earnings has also grown steadily. Those are two big components for the Warren Buffett analysis of companies. Is it consistently paying a dividend? Are the earnings constantly growing? That kind of a thing. And Buffett believes in not paying any dividends at all. He thinks he can do better with the capital than the investors can. That's how Warren Buffett looks at it, and he's right. So a constant growth model, therefore, seems tailor-made for the Aqua America stock. It says investors are forecasting that it would pay a dividend of 84 cents. And actually, this should be written with a 0 in front of it like that. Yeah. And actually, all this little calculus here, this should be jammed right in there. Good. And we didn't lose any of not just the algebra to back out how to solve for R. I put that in my sort of master file here. Yeah, because you're not buying rights to the debt, right? You're buying rights to the earnings. That's what you're buying. You're buying a right to the earnings. You're not buying a right. You're buying a right to the dividend, and the dividend does not go to the bondholder. So the forecast was the growth in dividends about 4% a year over the foreseeable future, and we explain in a moment where the figure comes from. If investors require a rate of return of 6.6% from the company, then so again, how do you say, well, the investor requires 6.6? I've never heard anybody, pare it down like that, but okay. Then the constant growth model gives a share value of just over $32. And we're going to go through what that is. So, and again, but there's a lot of assumptions here. How do you get to the assumption that dividends are going to increase 4%? Well, look at the historical values. Okay, that's sort of where you begin with that. So we wrote the number of shares, 141 million that we have. The dividend at the end of year 1 is 84 cents. The expected rate of return 6.6. The growth rate 4%. Dividend growth rate 4%, and we're going to compute the intrinsic value, and we're going to start backing out lots of numbers. So in terms of the valuation and with the formulas, again, this is just the same formula from before, but now the only difference is you got a growth rate, and this is not 0, and that's the difference from previous models that we've worked on. And now you're just subtracting these rates, and there's how you get your $32 a share, because you're looking at it, dividends per share. And the expected return, again, we're just playing games with the numbers divided by the price plus G. There's your 6.6%. And we have the total value of the stock number here. This is equal to the value at the start of the sort of your analysis year is right there. And this is equal to this number per share times the number of shares. And also, but it's in millions, right? So it'd be $4.5 million is what that would be worth. Does it say 4.5? Does it say that specifically? It didn't say it. Yeah, 4.5. Oh, billion. Pardon us. Yeah, 4.5 billion. Yeah, because this is not a period like in Europe. I was looking at European financial statements. This isn't billions, is what this is. That's 4.5 billion. So is it up here? Yeah, 4.5 billion. Okay. So again, we're tracking through very similar mathematics here. And now we're going to move into We're gonna have a graph coming in a second here. So today, and again, this is whenever these are mid-year numbers or something, right? Is this a mid-year? Yeah, this is the mid-year. So this is July 2013, July 2014, and whatever. This for when I wrote this, we're gonna add one to that, which is there. This 84, where does this come from? This is directly, and again, you would look at financial statements and things of that nature. That's the dividend per share, which is right there. And we want this to grow at 4%. So say equals that times 1 plus 4%. Lock that in with dollar signs. And actually, this I didn't hit shift hard enough. Shift 8. That multiple, that's the product. Okay. $84. And this is Control D, 91, 94. And we'll go through. So this, we reference this to here, to 84 cents. This is just 84 cents times 1 plus 4%. This is 87 cents times 1 plus 4%. This is 91 cents times 1 plus 4%. And this is 1 plus 4% times 94 cents. Okay. Now to determine the value, obviously you have to add these up, and I didn't do that here for some reason. I don't know why, but I didn't do that. So we should probably do that. Control U, and this is alt equals. Yeah, that seems to come out to $3.75 for some reason. And what we'll do is we'll say equals that 84 cents divided by parenthesis 1 plus discount rate, which you're going to lock it in there. And you want 1 year on that. Okay, this is this one, this one, this one, and this. Get rid of all these dollar signs. Get rid of the fill. That's just the summation, 375, which is way off of the $32 by a lot. Okay, and what we did here, what did we do here? Yeah, this thing, we made a graph of the dividends per share. We'll quickly make that graph. Okay, so yeah, it says graph. So what you do is you highlight your dividends, insert, scatter, straight line like that. Click your layout. Yeah, layout, legend, top. Right, those are your beginning movements with this. Click the graph, design, select the data, edit. Your x-axis are just these numbers. And this is G equals 4%. Annual dividend growth rate. Okay. And this is Aqua America. Your July paid. I probably used that terminology when we first started all this. Put a border around this, something like that. Okay. This, I don't know why this probably needs an extra decimal place for some reason. 1. Yeah. Because it's the half year. These are the half year numbers. And we're gonna leave it like that. This is years. These are annual. Dividends per share, something like that. We seem to move by 2 cents for some reason. We had 5 cents. We moved by about 2 cents. Expand this just a bit. You could even put some markers in here, format the data series, marker option built in, round. All right, you could look at it like that. Okay, you can wall this off a bit. You have a shape outline. You have a very light fill. Grid lines. We don't need grid lines. No line. And you do a nice shade. Format the plot area. Shadow. Do the first preset. And there you go. And you could even notch these. Down to a 4 or something like that. Okay. So that shows you the growth of those cash flows. Never bad. Never bad to have a graph like this. And we did it relatively quickly, right? This didn't take too long to do this. Okay. So yeah. All right. So and again, you could always make these, these could be smaller. These don't need to pop out at you or anything like that. And when you have 2 of them, you could do, one. Yeah, you could see your half year marks if you want or something like that. You could see those. These all correspond to 2014, 2015. How I graphed it up here, even though we said it's mid-year. We've already said it's mid-year, so you got to be careful. Well, you don't want to cause confusion. I'll say, hey, mid-year's here, but your dot is here. So that might be, if I had to make a criticism of this, it might be that. So, or in other words, if we change these back to no decimal place and made them bigger again, then you lost that actually this might work better like that. And now this is consistent with this, where it says those are the mid-year, the July pay dividends. Okay. And folks, always keep saving your work as you go so you don't get lost on what's going on. So we have sustainable growth rate, the firm's growth rate, if it plows back at a constant fraction of earnings, maintains constant return on equity, keeps its debt ratio constant. So this book, like so many finance books, tries to play all these games where if you multiply this ratio with that ratio times the return on equity, and and you get a magical equation that tells you what to do, which is really the point of a lot of these textbooks, is to give you, instead of knowing all the accounting, right, it's to give you a magical equation. If you multiply these couple ratios, and it'll tell you, and without even really understanding what you're plugging in, it'll tell you, what's going on. Where there's no substitute for cash flows, no substitute for understanding the balance sheet. There's no substitute for taking a 100-page annual report or 200-page annual report and reading it cover to cover and understanding it. There's no substitute. There's no math formula that's going to change that. You need to do that to understand an acquisition. There's nothing that's going to change that. But what a payout ratio is, what a plowback is. These added up correspond to, like, if payout is 0, then a plowback is 100%. So all the earnings go back into the company. If you're paying out half the earnings, half go to earnings and half go to plowback. So these have to add up to a factor of 1, basically. A sustainable growth rate it's the firm's growth rate that plows by a constant fraction of earnings, maintains a constant return on equity, and keeps its debt ratio constant. Again, that's one of the magical math conclusions of the Princeton folks and the NYU folks from a number of years ago. Okay, so we have however many, a little bit more to go with this. This next piece here, this is 1120 somehow at your measurement period. All right, $11.20. That's a book value, or book equity, $11.20. And the return on equity, or what your expectation is, and again, you're making lots of assumptions. Again, you can look at historical numbers to sort of compute this thing, is 11.5%. And then you're going to look at a couple percentages down here, the growth rate in book equity. So how do we do this? Here's book equity, which is here. This is okay. So the EPS is going to be the book equity times the return on equity. Of course, that's obviously got to looking at this. That's the return on equity. The equities cancel out, and you're left with You're left with earnings per share. Okay, so equals product. $1.28 to $1.29. Again, based on what you think your ROE should be. And again, we're giving you a very packaged problem with a lot. If you're doing this for real, you've got to determine everything. Again, there's no given. You start with some assumptions, and then you work your way through in a very explainable manner. Okay, and now here we go. Now it really gets interesting. So what you do next? You had a dividend at T1. You had your forecasted dividend of 84 cents. Okay, that was your dividend of 84 cents. And now you're doing sort of uh, a real computation of payout in a couple different ways. This was because if your earnings are $1.28 and you're paying a dividend of 84 cents, what's left to go back? What's going to go back into equity? The plowback is only 45 cents, right? So again, let's book equity. We could figure that out from the balance sheet. The return, again, that's the first. I would say assumption, but we could say, hey, we're looking for a specific return on equity. You could work that in there, and then earnings per share or the product of those, because the equities cancel out. The dividend is forecast from the previous problem. And so the earnings are 128 and you're paying 84 cents in dividends, you have 45 cents left. And now what you do is you're going to divide that 45 cents by the EPS, and you're going to divide the 84 cents by the EPS. That's how you get the 65 cents and the 34 cents, or the 65%, the payout and the plowback. How you get that? That's per share. And the check, how do we do a check here? Yeah, the check would simply be the book equity times the return times the payout. Yeah, I mean that's it. Or I'm sorry, 1 minus the payout, right? 1 minus the payout. So there you go. Okay. That's how you do sort of a way to do your check. And the growth rate, we're backing those. So a lot of these are just we're backing these numbers out. You take the plowback divided by the book equity per share, and that'll give you the growth rate. Right there's your 4%. So what are we really doing? We're working out this formula, the magical finance book formula. It's really what we're working out here. This other piece of this is just the return and then times the plowback ratio. That's all this is. We're just see. I don't do a hell of a lot of this uh, because I deal with accounting data, and just creating a bunch of ratios. It doesn't do much. Okay, people want to know in dollars what's going on, and that kind of a thing. And the equity per share is, yeah. So obviously, what goes back? So what goes back is from 11.20. Your plowback is 45 cents. That's how you get to 11.65, right? So that's of one of the most important accounting equations that you'll ever deal with is where your current book equity is, and then uh, what gets retained for the year, and then what the new value of equity is at the end of the year. In terms of the owners. And again, when I say that, I see a whole multi-line accounting model in my head because I've taught that stuff. But the finance guys are saying, "Oh, well, you can skip reading the accounting book," and I've heard people say that, which is simply madness. But I've heard that. I've heard that said. And some of this other stuff, you did the payout there and the payout there, and yeah, we did all. But did we do that here? Did we get these? Yeah, this we just simply took the earnings number times that ratio. Earnings number there. Right, that's just we're breaking this up based on these, sort of crooked numbers here. And then price to earnings are the EPS, and yeah, the $32 is really what that is at the end of the year. So you're and this is an important one. Your end of the year price to earnings is your price computation divided by the earnings per share. Now you got to keep things per share and all that kind of thing, and that's how you get 25. All right, that's this. The price that you computed divided by the earnings per share. And kind of, I'll let you sit there and look at that for a second, and hopefully you guys go back and figure out all the cells. Okay, you have to. You got to go back. So this was and here let's sort of review. This was an input. Okay, this this was sort of the last thing that we figured out here. This was the plowback plus the book equity. We'll get to that. This was an assumption 1150. It says from accounting data, and the EPS at the end of the year. You multiplied the 1120 by return on equity. The equities cancel, right? And what you're left with is going to be the per share earning number by multiplying these by multiplying return on equity. Okay, or earnings by equity times equity per share. You'll have earnings per share, which is what we have here. This is what your forecasted dividend is from up here. You forecasted that dividend in the previous problem. That's what that is. And obviously, if it's 84 cents, what's left is 45. And then you can create these ratios out of the 84 and the 45 cents over the $1.29. And a check in the change in book is the payout times the ROE times the initial equity number. I would avoid these concocted formulas like this because it's even for somebody like me that's very experienced. I said to say, what is that? I really try to break it down like an accountant would look at it, believe it or not. And then the growth rate is just the plowback divided by the equity, which is right there. And this is your check, the plowback times the return on equity. So that's ROE times plowback ratio. And these are a couple checks here of how we broke down the earnings per share based on these percentages. Okay. And it says mature companies grow by reinvesting earnings, and how rapidly they grow depends on both the proportion of earnings reinvested into the business and the profits generated by the new investments. If this company can turn to return on equity 11.5% and plowback 34%, the earnings into new plant equipment, the earnings dividends will also continue to grow by 4%. So it's trying to forecast where you're going to get growth wise by the percentage of plowback. And I get why people care about that, but it's more focused. I'm telling you, it's way more complicated than how it's being presented here. But okay, it's a good start though. This is the earnings, the plowback divided by the initial equity. That's how you get your 4%. And this other piece of this here, this is the plowback times the ROE. And again, it's all this hocus pocus with, oh, we multiply this ratio and that ratio. And I get it. The CFA exam cares a lot about these things, but there's, you have to really be able to explain this and to explain these multi-product equations to the spectrum of people out there may not always be, because let me tell you, if you start turning people off by being too tactical, I'm telling you, that's gonna work against you. I'm just telling you that. So always keep that in mind. EPS is ROE times book value. Earnings will go 4%. And what about dividends and earnings? See, also, people studying the S&P 500 and the Dow Jones, they're just looking at the earnings lines. Not that they don't read the whole company as if they're buying the whole company, but they just sort of look at that. We've made decisions on acquisitions based on way off these lines. Certainly earnings related. It's a decision based on an acquisition based on the earnings, the health of the earnings, but it's not this. I'm just saying it's not this. If the payout ratio is constant, dividends will be fixed proportion of the earnings, and they too will grow. And again, all these magical conclusions. So if ROE and plowback are stable, then the book equity earnings that will increase. Okay, I'm sure it's all true. It's all true. And this is that formula, the ROE times a plowback. And I'm sure this is a big part of the CFA exam. I'm sure it is. And this just repeats itself here. And we get our old friend again, how we derive the expected return based on growth and dividends a year out and things of that nature. So, okay. This came from where different places. This looks like it came from the 0.8 and the 4% and the price. Oh, the folks, pardon me. This is just this. All right. Divided by the price, which is the 32, plus the growth rate. Yeah, there's your 6.6%, and we just validated that the expected rate of return is all we did there. It's not unique to this, that number is not unique to this company. It's set in the market for common stocks and cannot change its value of R by paying a higher or lower dividend or by growing faster or slower unless it changes. But notice how the whole conversation comes to dividends and earnings, and again, some sort of magical analysis of this. Folks, the company behaves based on the fundamental decisions that are made on policy by management. That's what impacts earnings, and that's what impacts value. All this other stuff, it's nice to know. We have a nice conversation about it, but um, tweaking these ratios, you're playing, sort of theoretical games with it. It says it's determined by the rate of return offered by other equally risky stocks. Return determines how much investors are willing to pay for Aqua America's forecasted future dividends. Okay, and this is what the stock price is, and right, given stock price, growth rate, and dividend, how we determine expected. So yeah, we did all that stuff, and here we are again, and this is basically the dividend yield plus the growth rate. Or if you really look at what this is, that's the dividend yield is what that is. The required rate of return is not a unique property that a stock or any other stock, and it's set in the board market for common stocks. Okay. Investors set the stock price based on the rate of return offered by other equally risky stocks, and the returns determine how much investors want to pay for certain stocks with future dividend. And really, the whole, at least my angle on valuations is what's the cash flow going to look like for this? This next version of this, we have that same 84-cent dividend. We have the same 141 million shares. Now we have a 6.6 discount rate and a 5% growth rate. Okay, so this is, how did this change from what we had up here? Yeah, this is 4%, and now we're looking at a 5% version. So again, if you have a bigger expectation of growth, hence bigger earnings, bigger dividends, kind of a thing, you have a bigger valuation is what even though the rate of return is 6.6, 6.6%, but you can see V0 now is 52 as opposed to 32 or whatever it was, the smaller version that we had before. Okay, so we're here with this. Yeah, this was the whole V0 thing. So this was equal to dividends divided by parentheses, this minus 50. And now, and obviously, and we'll use the same valuation formula that we had up here. This is like 7 billion, right? This one. Yeah, that's 7 billion. All right, because again, we have a expectation of higher growth of the company, higher growth of earnings. That's what that is. Yeah, see that factors in there, right? That it comes into this, that comes into that, into what the intrinsic, into what the value is. Again, when you have G is at 0, and when G is higher, you're going to get a bigger valuation, and then the expected return, we're just backing out dividend divided by price at times 0 plus G. Yeah, so you have a shift in growth based on just economic factors in the markets. That's really what that's saying. So the stock price will jump a bit, more than a bit, 67% higher. So, right, but we'll offer the same expected return. Okay. Yeah, so you get the same R out of this. And again, you got to sit and think, well, I mean, uh, do we have 6.6 up here? We had six. We had a different growth rate, but okay. You're paying a higher price to get in a sense, but so the dollar values will be higher, but you're also paying a higher price to get that. That's why the 6.6 is the same. And again, that's the nuance with this stuff. They're folks. I'm saying, don't try to learn accounting from the Breely Myers book. Okay, don't try and do that. That's my advice to you guys: is to not try to learn accounting from Breely Myers. That's for sure. This is that copper example. This is again a 6.6% discount rate, 5% growth rate. We expect a $5 dividend. So this is going to be equal to parenthesis dividend divided by 6.6 minus G. Okay. It says investors expect dividends to appreciate at 5%. And okay, the market is pricing in 100. The market is pricing in 100. It says so we're starting with a valuation based on the market, and then from there want to determine the expected return um, for 100, which is higher than the 32. So obviously the expected return is going to be higher than 6. So again, if you pay more to, uh, you know, if your valuation is 32 and you're paying 100, you're going to alter that expected return. So this is going to be equal to that dividend divided by a bigger number plus G. Yeah, there's your 10%. And you don't have shares. You have to worry about the shares of stock or anything. That's all just zero. Okay, but this is where it's similar. Yeah, 6, 6. This was 6, 6, and 5. So again, looking at a different expected return. If you're coming in at 52, right, your return, you're looking at a 6.6 return. But if you're coming in at 100, it can change. So the price you come in changes what the return is going to be. Okay, that happens every time. And so if a company earns a constant return on its equity and plows back at a constant proportion of earnings, then the growth rate is equal to the sustainable growth rate, return on equity times a plowback. For a growth stock bought by investors with expectations of capital gains, interest in future growth rates, growth of earnings rather than short-term dividends, income stocks are bought by investors primarily for cash. Yeah, so here's sort of the definition of what a growth stock is, what an income stock is, and again, in the finance world, you'll hear people use that terminology often. There's 84 cents. All that. And again, you're looking at 141 million shares, and you want to figure out the valuation of this. So this is the rate was 6.6 and 4. Okay, we're at the same. So I guess we're just redoing this, I suppose, or going through the steps of this, the rate and the total stock value. Yeah, this just looks like a redo, but okay. Yeah, so you got to take that price that you determine. Yeah, this is just equals dividend rate minus G is 32. And your expected return is simply the dividend over the price plus G. Okay, we had to bring this down because now we have a new assumption, and it says okay, we expect the dividend to be 84 cents, and now instead of 4% growth, we're looking at 5% growth, and we're looking at with this new rate of return, assume 65, 35% payout plowback. So we have some new assumptions here. Yeah, we have some new assumptions that we're gonna ratchet into this. Yeah, and that's it, I think. Yeah. So okay. At least for this column. So and actually, you know what? Just looking at this in terms of time, um, I think we're good here with this. Yeah. So, yeah, I think this is as far as we got with this, and then we have yeah, I think this is as far as we're gonna go with this, which is fine. And I think we're gonna be looking at, I think we'll be looking at this like that. Yeah, that's as far as we got, I think. Yeah, that'll be 4 is what that's gonna be. That's 4. Folks, I'm doing a little video planning here as we're sitting here, so, yeah. Yeah, let you guys absorb. Yeah, we're not gonna hit value of a business, that we're not gonna do yet. I'm saying we will, but we're not gonna just do it right now, so, yeah, we're getting to that, fine. Okay, so we're here with this. We looked at copper. Yeah, okay, so we're here with that. Alright. This was at 11.20 that was in there, and again, the return on equity, 11.5%. And this is where yeah, the EPS is just this. Right, that 128. That's all that is. And this is simply that. Same thing. Once, yeah, and then we're going to look at obviously the plowback amount is obviously going to be 0. You're paying back everything. You're paying back everything. So your formula here would be the dividend forecast divided by the EPS. It's all going to be dividend, and none will be plowed back. That's just 0. Okay. So that's so looking at this, the company would never grow in a sense where ROE times book times 1 minus 100. Okay. You have that formula. And we discussed this, where the equities cancel, you get uh oh wait, not the equity. Yeah. So this is equity times ROE. Yeah, then times 1 minus the payout. And if you're paying everything out, it's just 0. Because there can be no change in book value with no reinvestment back in the company. Okay. Right. That's your earnings, or your earnings per share comes from there. Okay. And the rate here, this is This is the plowback divided by equity. This one you just add. This is the same formula from above. Add the plowback that's still 0. And this is ROE times plowback is what this is. Okay, and this is simply this is EPS times payout. EPS times 1 minus payout. Okay. So this is just, we sort of had an extreme situation where the entire EPS gets paid out as dividend, and there's no way to grow the company. That's really what this says. And price to earnings would be I don't know why it's referencing nothing there. That's weird. Let's see. With this, you still have that earning, and let's peek in the book. Oops, that's not what I wanted you guys to see. That's something else we're working on. Yeah, this was the G. Yeah, that was G0. Yeah, this is G0 right there. So, um, Yeah, they're breaking it. They're breaking it up here based on a future investment and things of that nature. So a little more of a sophisticated example there. Um, yes, this really should use these numbers, right? A price to earnings of 15, right? I would think that would be a better shot for us. We don't have this yet, but here let's sort of scroll down here. It says assume the company paid out earnings at 129, would forego any future growth in earnings and dividends. And once again, you're at 141 million shares. Discount rate 6.60 here. Okay, and this would be your value today equals, and your dividend is right there, your 129. Yeah, there's your dividend, 129. Yeah, and again, this is you're looking at July to July with the movement in this. All right. Well, the value here would be shares outstanding, and we didn't compute that price yet, but that's the formula. That's the formula that goes in there. So we'll worry about that in a second. This is simply the same thing. After 1952, and your valuation is 2.7 billion, which is our low end, right? That's our low end valuation. Okay. Right, because we're referring to this up here, and now your price per earnings are this 19 divided by these earnings. That's how you get your 15.15. Do we get that here somewhere? Do we have 15.15? Yeah. I don't think they don't mention, they sort of leave. Yeah, this book was written very off the. Oh, here it is. Yeah, 15 point. Yeah, 15.2 is right there. It's written very much off the cuff. I really try to formalize what we're doing here with this stuff, which is fine. I mean, that's, hey, these guys, they wrote it in the style that they wrote. I would write it a little more sort of step by step, but yeah, I see what they wrote it for mass appeal as opposed to you know drilling like the Marine. I would write it like it was the Marine like a Marine Corps manual is how I would write it. But that's just how I look at it. So, and then you have dividend over price plus, and you got your 6.6 again. And now we break it up into sort of these pieces here. So at that particular growth rate, what are we doing at this growth rate? Yeah, so the intrinsic value, we do another one of these intrinsic value deals here. This is equal to dividend divided by 8 minus G. And in terms of the scenario, this is about Yeah, that 32. So this is equal to parenthesis 19 minus that original price that we had up here was 32 something, which is way up here. And then divide by the old price. Yeah, you're at about a negative third difference. And now they're breaking up values or value of assets already in place and how we got to the 32 and all that. So this is simply that 19.52. This equals 32 minus the 19, and then you sum these. And that gives you your 32. And also, what do we do? In terms of the G, you took the 6.6%, which is your well, that's the 6.6 is the discount rate. Discount times plowback. Um, yeah, that's not G, folks. That's not G. So I don't know what we're looking at this. And how do we use that? Well, it's using G here. And there's your discount, fine, which is good. Dividend. And that 2.2 is a 6.6. And we use the plowback, the plowback from up top. But again, all this, it gets so mishmashed with all these. So now that's sort of your another G that you're using. And you're going to take your dividend. And we're just going around and around and around in circles here. You're going to take your 84 divided by parenthesis. Minus this G, which was here. Another way to get 1952. All right. Yeah, this is the no growth company value. These guys took the discount times that 34 somehow. Yeah. Okay. And this is just simply the difference. And this is the present value of future investments. So it's that stock price is broken down into those couple pieces. And then we have a little more to go here. As is plowing back the earnings into new investments may result in growth in earnings and dividends, but does not add to the current stock price. If that money is expected to earn only the return the investors require, the plowing back earnings does add value if the investors believe that the reinvested earnings will earn a higher rate of return. Okay. And looking at this is value of assets in place. This is present value of growth opportunities. Okay, that's where you get your 32 from. And the home stretch of this, uh, you have the PEs based on these different share prices. And this is just PE based on our different valuations. It says based on the $32 share price based on the 19. So this is just based on the earnings per share and you know, what you're paying in price for that 129 of earnings. That's all that really is. And this the merciful end of this is what? This is our last problem here. It says instead of plowing back money into the lucrative ventures, it's investing the expected return on equity of 5%, which is below the return of 6.6 investors could expect to get from the comparable securities. Find the sustainable growth rate. Continue to assume a 35% plowback. Find the new value of its investment opportunities. Explain why the value is negative despite the positive growth rate of earnings and dividends. If you're corporate rated, would America be a good candidate? Oh, okay. So your ROE is 5%. Yeah, expected return on equity 5%. And assume the payout ratio of 65 to 2. There, we referenced the previous problem. And so what you do is you're again sustainable growth rate. You're going to multiply ROE times the payout ratio, 1.74%. Okay, the dividend. This comes from up top someplace. There's your 84 cents in dividend, and you're looking for And this is simply equal to dividend divided by parenthesis. Minus G. Take your 1728, right? It's just that 6.6 minus that 1.74. The numerator is 84. It's just this. And our final version of it's the difference from the no growth model would be this minus that 19. That's 52, 32. Oh, yeah, this is the no growth, which is 1952. There's a $2.23 difference. Okay. Yeah, and these are, is that your acquisition price? Or how happy are you with the rate of return? Okay, so all those questions are all valid acquisition questions. Okay. Yeah, this actually took a little bit longer than I thought. I thought I was going to get to the constant growth part of it here in Home Depot. I don't want to rush through these, and so this is a good place to sort of put a fork in it. So yeah, so these we're going to do this here like that, and then there'll be a third one, a fourth one, and we'll hit those in the days coming up. Yeah, so what's coming with this is non-constant growth and a little bit of work on Home Depot, value business by discounted cash flow model, and then this big one, the S&P 500. Sort of there's no free lunches discussion, which will be a lot of data. You can see all the data here, the data rows, and we'll update this. This stops at 2019, but we'll update this to current readings on the S&P. So we have two more exciting videos happening. Okay. All right, folks. Thank you.